Hello and welcome to our summer update for our investment series where I'll be interviewing one of our investment managers, John Jones. Going to follow the same format as we have with a number of these different interviews. So we'll dive straight in. So John, how are you?
I'm okay, thanks. Good morning.
Good morning. So what's happened over the last sort of quarter or so? What's been the big changes and what's happened really in the world?
I think it's fair to say the last quarter, Q2 of 2025, has been exceptionally volatile. There's no hiding from that. It's been dominated by mainly tariffs implemented by the US. The reality of tariffs and also the threat of tariffs on other nations has caused massive volatility within markets. Most clients will be aware there was a bit of a sell-off in early April after the Liberation Day, April the 2nd from President Trump. So there was a sell-off in equity markets. We'll get on to, there was actually a positive outcome of that. We'll get onto that shortly. And the only other, well, there's many factors, but another noticeable factor was there was quite a lot of geopolitical volatility with conflicts in the Middle East. Do you want to go straight in?
Well, let's talk about what happened in April, because I think that's the key change that we did. So what happened obviously there was a dip in April. How did we respond and what's been the result of that?
We were in the fortunate position, pragmatically speaking, that we were actually bearish, -1 on equities heading into April. We were negative on equities based on valuation concerns. So when Trump announced his Liberation Day tariffs, the market responded quite negatively. Equities drew down significantly. Therefore, in the first 2 weeks of April, we dialed back in to equities to enter a neutral position overall.
So when you say dialed back in, we basically bought more equities.
Exactly. We bought back into equities and we could buy them at a favourable price because we basically held off, seen a nice point to enter, re-entered, and we weren't particularly overexposed when we re-entered because we went back to neutral, what clients would expect. So imbalanced, we were back at 50% equities. And the equity markets have ran positively for the last 2 months. Numerous things have caused the positive run, but one of them was a lot of market commentators and markets didn't see the tariffs as bad as what was being expected. Many were rolled back, many were revised. It was basically an open conversation between countries and Trump, and the equity markets responded positively. There was a little bit of positivity from some geopolitical volatility dying down, in the sense that Middle Eastern conflicts, without going too granular into them, seem to have tapered down, and at least talks were ongoing. It's not to say this is the finalized picture. As we know, tariffs can reappear at any given time. Middle Eastern conflicts in Europe can reignite at any time. But we basically got a little bit positive uplift from equity markets.
And we've also had some positivity from the currency side as well, haven't we?
Yes, the weakening dollar, strengthening pound, that benefits the fixed interest side of multi-asset portfolios, because most of ours is heavily weighted into the pound.
Yeah.
So with the pound strengthening, we get a bit of uplift. Yeah.
Great. So obviously we've just done the most recent changes with the scheduled changes, unlike the unscheduled ones, which we did in April. So what are you doing? What are we changing and why?
Yeah, I think it's fair to say, firstly, the midpoint was the 3rd of July. So clients might see that a lot. The 3rd of July was the point of action. Basically, you can view it as a rebalance because there was changes made in March and April. One of the main reasons for a simple rebalance, because equities have performed so well, they've actually slightly got ahead of their target allocation. So for example, we're currently sat at neutral, but because of the positive market uplift, natural drags took them to imbalance to around 52.5%. We thought with potential volatility heading into the second half of the year, take some profit off the table and rebalance the portfolio to sit more comfortable.
So a little bit of profit taking, basically.
It was profit taking, exactly. Same with alternatives. We took a bit of profit from gold, rebalances across the whole portfolio, took a decent profit from gold, and also bought back into fixed interest. On the fixed income side, we did actually a little bit of a change here. We previously employed a static duration across all portfolios of roughly 6 years, duration just being sensitivity to interest rate changes. We've actually altered this and gone more of a linear approach. So the lower risk portfolios are in lower duration, which is lower risk essentially, and the higher risk portfolios, higher duration. The reason we've done this is we think there might be a little bit of volatility to continue into the second half, and we just feel that's a much better and more comfortable position to be sat at. Yields are still particularly attractive even in the shorter space, so there shouldn't be a yield, it shouldn't be negative to the yield. Should still be getting nice yields. So there's no overhaul change. That's just a slight tweak.
Okay, great. And obviously, no crystal ball. Probably have to buy one at some point. But yeah, say boy,
Yeah, I think we should.
see what happens. But what do you think is going to happen because of these changes over the, well, let's say the next 6 months? So keeping it quite short term.
Yeah, I think
Which I know is tough.
great question, tough, but I'll give it an answer. I think it's fair to say where I'm sat. I think volatility might still be present in the second half of the year. Doesn't look like Donald Trump's going anywhere, so you still might see things affected from his end. However, I'm quite positive on the alternatives asset class.
Okay.
We've just rebalanced gold, so I'm quite positive on gold as a diversifier and as a downside protection tool in case there's an unexpected surprise in markets. And we're also invested in silver as well and commodities. I'm positive on them because, one, if inflation does spike up for whatever reason, whether it's governments announcing new stimulus measures and maybe they don't plan to the inflation side properly, we should see some protection in the alts basket. So and also, without sitting on the fence, I'm happy we've rebalanced generally because you sat at more comfortable allocations. We're not over or underexposed either way. I know that sounds a bit sat on the fence, but a shock shouldn't materially impact us hugely because we're not over or underexposed. And still positive on equities. They've been on a bit of a stormer, so they are being closely monitored from that perspective, from a valuation point, but positive on equities. Fingers crossed the last month of quarter two continues into the second half of the year. But yeah, positive on alternatives generally.
So generally overall, reasonably positive. Kind of, obviously that's in slight difference to what the news is doing. So it's kind of ignore the news, focus on what the actual hard facts are.
Absolutely.
And going forward, things look like they should be okay for the next sort of quarter to 6 months.
Yeah, equities, well, just going back to the portfolios for the whole half of 2025, portfolios performed positively and they've all performed above their weighted benchmark. So that was a strong and positive indicator. Fixed interest is sort of, it's performed well from yield point. It's still performed positively. Still think there's sort of there's room to run. Equities have performed exceptionally strongly, and alternatives, specifically gold, has. So the rebalance has brought them back down to neutral, because they still hold their position and their worth. It's from the downside point of view, and it's just in case of a shock in terms of inflation. I think inflation and inflation stories here for the medium term. So we see it as still a safe downside protection to hold these assets. Equities are doing well, but again, the caveat is they are at the more expensive end at the moment because the bounce back has been significant. So we're constantly just monitoring that.
Okay, great. So thank you very much. That's the update for the most recent quarter. And of course, we'll be back again in the autumn when we've done another series of changes and see what happens there. So thank you very much.
Thank you.